This is the Rational Reminder Podcast, a weekly reality check on sensible investing and financial decision-making for Canadians. We're hosted by me, Benjamin Felix, and Cameron Passmore, portfolio managers at PWL Capital.
So welcome to the dog days of summer. So as I was waiting for you to join the recording here, I didn't know what dog days of summer were, even when it was. I knew it was summertime. But do you know what the dog days of summer comes from?
No.
So it's actually July 3rd to August 11th. And it's the time of the year where the sun occupies the same region of the sky as Sirius, which is the brightest star visible from any part of the Earth, and is part of the constellation Canis Major, the greater dog. So there you go. We're just starting the dog days of summer. We are recording this on the 9th, Friday the 9th. And also now know where the dog logo comes from in the Sirius XM logo. Didn't know that either.
Interesting.
So there we go. Yeah. So dog days of summer. So we're recording Friday because I'm off at a cottage next week. So I'll finally have a week of living kind of like what you live every day now at your new place.
It is like a cottage here. One of my neighbors said he was going to the cottage. And I was like, don't we kind of live like, isn't this where people go to be at a cottage? But apparently when you live here, this becomes eventually, I guess it's the adaptation principle. He was like, wow, it gets so busy here in the weekend. I was like, what are you talking about? But I guess remote has a different definition once you've lived in a relatively remote place. So yes, my neighbors think that where I live is a bustling hotspot. But I'm like, hey, go spend some time on Preston Street. And
yeah, you're not dragging your kayak down Preston Street. Anyways, I was talking to Angelica earlier, and she wants us to do a summer promotion in our store. So for those who don't know, on our Rational Reminder website, so rationalreminder.ca, there's a little shop button. We have a whole pile of products in there, such as our regular mugs, our guest mugs for the first year and a half or so, water bottles, T-shirts. Some people say our hoodies are the most comfortable hoodies ever. Ben is sporting blue. I'm sporting red today if you're not on the YouTube. And anyways, also every order that we get while supplies last gets a free pair of Rational Reminder socks, which are pretty snappy, and we do free shipping in North America. But for people listening to this episode, if you go from July 15th, which is the release date of this episode, to July 29th and order something, at checkout, you'll be asked to enter in a code. If you enter in Rational Summer, all lowercase, you'll get 20% off. It's not bad for a Dog Days of Summer feature.
No, it's very cool.
We'll see if people are listening and wanting to check out the store. Anyways, this stuff is nice. One podcast I wanted to highlight that I thought was really cool, I listened to this week. Barry Ritholtz on Masters in Business interviewed Brad Stone, who is the senior executive editor for technology for Bloomberg, and also the author of the recently released book called Amazon Unbound. Unreal story of Amazon and Jeff Bezos, and how he keeps pushing the strategy envelope into so many things. And when they go through the different decisions they made as a company of things that did not exist like 3 years ago, 5 years ago, 10 years ago, it's unbelievable. You think about the decision to have Prime Delivery, right? Which is the subscription-based delivery service, but then they're able to monetize by having merchants pay ad revenue to get higher in the rankings of products. So effectively shifting, the way I interpret it, shifting delivery costs onto the suppliers. Prime Video, Amazon Web Services, which is like a $50 billion business now or something.
That was a big win.
Whole Foods, they talk about Washington Post, Amazon Music, and it just goes on what they've done. Also some flops like Fire TV as well as their own phone. But to keep pushing so hard like this to create what they did, and then you get the pandemic, which just simply accelerated virtually every part of their business, which is crazy to think about. Like, look what it did to like Prime Video on demand, for Alexa, for the basic shipping of Amazon, food service, food delivery, and AWS. It's absolutely mind-blowing. They added 400,000 employees last year. They raised minimum wage. Anyway, great interview. Barry did a great job.
That is cool. There's success comes when opportunity meets preparation, and Amazon was in a very good position. The pandemic for them happened to be a pretty significant opportunity, and they clearly capitalized on it.
Yep. Upcoming guest, Bill Schulteis, we've mentioned a couple times, author of Coffee House Investor. Katie Milkman is after that, author of the book How to Change that we've talked about. We interviewed her yesterday.
That was a great conversation.
Agree.
She's an engineer who studies social science. It's a great outlook, great perspective.
And then the next guest after that is Dave Pleka, who's the global head of fixed income at Dimensional Funds. So to prepare for that, I suggest people go back and listen to your description of factor investing in fixed income, which was episode 138. In the community, we had some interesting feedback lately. One was from Abby, some very good feedback. She said, hands down, I believe it's a she, hands down best finance podcast out there. And our forays from finance into other areas of broader life and satisfaction are captivating. So that's kind of been our goal. Another one from M Reviewer in Brazil. I thought of calling this a transformational show for finance geeks, but I realized that it is not. It's interesting and insightful for geeks, but the transformational piece I reserve for, quote, us, the layman. I thought that was nice. And I thought you may want to talk about the third one we got, which you got a kick out of.
Patrick from Sweden said that this is his top #1 finance podcast by far, and he loves the academic approach to investing. It really feels like we want to help him and inform the audience. Greetings from Sweden. Very nice review. And it's his #1 finance podcast, and he gave us 3 stars. So my question to Cameron when we saw that was, I wonder how many stars his #2 podcast gets.
Maybe 3 stars means more in Sweden. I don't know.
Maybe they've got a 3-star system. Angelica said that it was probably a mistake, but we appreciate it regardless.
Yeah, exactly. In the community, some people, I was talking to Angelica, I hadn't noticed this, but some people are really taken aback when you said on the last podcast that you do not have goals. And she said, ask Ben about that. So I guess a lot of people were quite surprised you don't have goals. I mean, I know we're driven. I think you and I both focus on the quality of work, perhaps work too hard, but we do enjoy it. But we don't set concrete targets in that way.
Never set goals. Stuff just happens, and you do
keep your head down.
Do a good job, and I don't know. I never set a goal of having a family, and then, bam, 4 kids. Stuff just happens, and you roll with it. I don't know.
Yeah.
Do your best.
But you prepare. Like, we prepare for things. I've never been a fan of setting certain business targets, for example. Like, you can only control the activity. You can't control the outcome. But you have to be prepared for what could happen. So you're
it's like what I said a minute ago, that success comes when opportunity meets preparation. You can't really control the opportunities, but you can control the preparation.
Exactly. As always, you can connect with us on Peloton, CP313, or hashtag Rational Reminder. I'm on Goodreads. Love seeing people there. We're both on Twitter. Rational Reminder, I think we're now over 500 followers on Instagram, which is kind of cool.
Are we really?
Yeah.
Wow.
A lot of people showing up over there. And I must say, Angelica and the team really up, I think, the look of their Instagram page. It's nice.
That's cool. I've never actually seen it. I've only seen the screenshots that you send me because I don't have Instagram.
You're not on Instagram. You didn't see Oscar wearing the Rational Reminder hat? That was a big hit. You see Oscar behind me here. Oscar was a big hit. Anyways, we should get on to the episode.
Yep, let's go. Welcome to episode 158 of the Rational Reminder podcast.
So, quick book review this week, one that I read a long time ago that honestly I'd forgotten about, but it was referred to me by a friend and peer named Hugh. So thank you, Hugh, for reminding me about this. So the book is called Playing to Win by Roger Martin and A.G. Lafley. So I was talking to Hugh a couple weeks ago about just become kind of curious about how to create, manage, develop a company's strategy. And so Hugh said, you got to check out this book. It's pretty well regarded. So I downloaded it and loved it. So it's written by, as I said, A.G. Lafley, who was was CEO of Procter & Gamble, and Roger Martin, who was a professor at University of Toronto's Rotman School, and who at the time was a consultant to A.G. Lafley at P&G. And it's an excellent read, and it defines strategy as the integrated set of choices, and I highlight choices, that uniquely position the firm in its industry so as to create sustainable advantage and superior value relative to its competition. So that sounds like a great MBA type sentence. But they really highlight how it is about choices and understanding the trade-offs between different choices to execute on a strategy. And they go through, and I'll give the 5 choices that they identify that relate to winning, but they tell this all through the lens of products at P&G, which was way more fascinating than I thought it would be. Because it doesn't really matter what the product is. These choices matter no matter what business you're in. So number 1, what is your winning aspiration? What is the purpose of the enterprise and its motivating aspiration? Number 2, where will you play? Where will you achieve your aspiration? And they really highlight there, have deep consumer understanding. Now they highlight in that section that it's not up to you to go and tell consumers what they want, but to understand them well enough that you can help them articulate in your space what's a benefit to them. And the example they gave is toothpaste. So toothpaste for a long time was all about preventing cavities. You know, consumers want to prevent cavities. Then it morphed into, well, is it whitening? Is it sensitive teeth? And it became oral health was a big thing that was a hot button for people. Number 3, how to win. What is your value proposition? What is your competitive advantage? You know, is it innovation? Is it research and development? Another good example there was the Swiffer example. And I didn't realize what a blockbuster success Swiffer has been, but they were losing in the hard surface space, which is, you know, the cleaners and Pledge, I guess, and stuff like that. So they were losing worldwide in that space, but they lead the world in paper towels, which is the Bounty paper towels, you know, the quicker picker-upper. So they were able to bring that technology with the liquid materials that are used on surfaces together in one product, being the Swiffer. Complete blockbuster, wild success for Procter & Gamble. So I thought that was a great example. Number 4, core capabilities. And number 5, to have the management systems and measures to enable and support choices. And they talk about how these choices are made throughout an organization, from the overarching guiding strategy to the frontline employee in a retail store, for example. Anyways, they highlight winning is the heart of any strategy. Otherwise, they say you end up getting mediocrity. So love the book. Hadn't realized it was the second time I read it, but it was great just the same. Any thoughts on that, or just keep rolling?
No, I'm just thinking about the fact that I should probably read the book too. It sounds very good, and I think people know this because we talked about it in the community. But the reason that you've been thinking about business strategy is because we just had this pretty significant transition where you took majority ownership of PWL. So I guess I'm just saying that because people should maybe not be surprised if stuff like this is a bit of a theme in terms of where your head is at for the next little while.
A couple of news stories in the ETF space. Canada showing continued popularity in ETF sales. So year-to-date sales of $29 billion. So year-to-date for 6 months of 2021 is 35% over the same period last year, which was also record. However, crypto sales last month were over $1 billion in May, fell to $315 million in June.
Wow.
Still a very small part of the market compared to mutual funds in Canada. But get this, there's 1,118 listed ETFs in Canada.
Unreal.
And then another interesting tweet from Eric Balkunas showing the top 25 US-based asset managers. So this is not ETF managers. These are asset managers, which together manage over $52 trillion of assets. And he showed what percentage of their assets under management are in ETFs. So overall, the 25 largest asset management firms have 12% of their assets are in ETF structures. 5 years ago, and he made this as a surprising statement, 5 years ago, half of these firms had nothing in ETFs.
Wow.
But the reality is there's very little change even today, because almost, I think it's 12 of them have either nothing or very little in ETFs. But get this, of the 25 largest US-based asset managers, 4 firms have a large percentage in ETFs. So I would say that's 27% or more. BlackRock has 34%.
This is 34% of BlackRock's total assets.
Total assets are in ETFs. So 34%. Next is Invesco at 29.6, State Street at 29.3, and Vanguard at 27.
Wow.
So it shows even Vanguard has a lot in mutual funds, right? So
Yeah.
those are the big 4, all almost at 30% or higher. Number 5 firm is Dimensional at 4.7%.
So 4.7% of their total assets are in
Total
ETFs
asset.
at this point.
So their assets right now, Dimensional is 637 on this chart, 637 billion US, and they have 30 billion in
I think
ETFs.
they became, by doing these conversions, and they launched a couple of ETFs as well, but I think I read they became the 11th largest ETF manager in the States just by basically flipping a switch.
That's right. So that's why there's other firms that aren't on this list that manage more ETFs, but they're smaller in total assets.
Got it.
So these are the largest asset managers and their
Got it.
percentage in ETFs. I just
Wow.
thought that was interesting.
Yeah.
Other thing that's interesting, and this is a shout out to Ben Carlson at Ritholtz, who did some analysis on his recent blog looking at Robinhood, which filed its S1 to go public sometime in the near future. Some crazy data points on this. There's close to 18 million active users on Robinhood with $80 billion of assets. 12 billion of that is in crypto. More than 50% of the users on Robinhood, this is their first ever brokerage account. 50% of all new retail accounts opened in the U.S. since 2016 are on Robinhood.
That's crazy.
Get this one. 47% use the product on a daily basis. And of those that use it daily, they visit the site 7 times per day. 98% use the app on a monthly basis. Now, they've had some bad news lately where Robinhood had to pay a fine for what are quoted as outages and misleading clients. Revenue is skyrocketing. In 2020, they made almost $1 billion in revenue, up from under $300 million in 2019. In Q1 of this year, of 2021, they made $522 million.
Wow.
Which is more than half of what they made all of 2020, which was triple what they made the year before.
Yeah. Wow.
So much of the revenue came from pay for order flow, which we talked about in the past. They make a ton off of options. Options make up 3% of the assets, but they make up 38% of transaction revenues in Q1. I didn't know this, but when they go public, I guess they're holding back a fair chunk to be available to their own customers, estimated to be between 20 and 35%.
That's kind of neat.
Yep. So Ben makes a comment at the end of his article saying it's wonderful that Robinhood has gotten so many new investors involved in the markets and they had an impact in driving down trading commissions. True. However, he says people always drink more at an open bar. That's what we talked about a couple of weeks ago. Like, is this access and easy access and gamification actually good for investor outcomes?
Fascinating.
I guess we'll see.
I think that fine was for, part of that was for, I think it was about the execution of the trades, right? Where they were advertising free trading, but the costs that their investors were actually paying were more than if they had been paying commissions at a different institution.
When you factor in the pay for order flow effect?
Yeah, the quality of the execution on the trades. It was something like that. I remember reading about that last year. I don't know. I think that's probably the same fine, but I'm not 100% sure on that.
Hate to say it again, but I will. If you don't pay, you are the product.
Yeah.
On to the big topic today, which, although it's super nerdy, I'm super jazzed by it.
You know, just to finish up on Robinhood, like the frequency that people are using those accounts, I can't tell you how many times I've had conversations with our clients where they literally haven't looked at their accounts since the last time we met them 6 months ago, or other cases where they haven't set up the online access that we've created because they just never look. Like, oh, you have a way for me to look at it? I never looked, so I didn't know. It's such a big difference in the characteristics of the type of people using our platform versus Robinhood, which I guess is obvious to say, but yeah. All right. So the nerd out geek topic, tax loss harvesting. Now, this is something that we've talked about before in past episodes, and I had done some analysis on it, but I revisited it because it came up. It came up in some stuff that I was working on, and I found a bunch of resources that I had not dug up the last time I looked at this. Last time I had just done my own number crunching and come up with some conclusions. We'd come up with sort of the optimal case for when loss harvesting would make sense, and talked about some of the different risks that are involved and stuff like that. But I think this is a much more robust analysis of loss harvesting. So we'll dive right into that. One of the reasons I think it's relevant to talk about is that it's often promoted as a strategy for high net worth investors to be using. A lot of firms present it as a value added. Like, you should deal with us instead of these guys because we do loss harvesting, or you should deal with us instead of doing it yourself because we harvest your losses.
Well, it's just a throwaway, you got to do it kind of thing.
Yeah. And you see it with robo-advisors too. Like, I haven't looked at Wealthsimple's offering in quite a while, but I know at a point in time they had, above a certain asset level, you could choose to turn on loss harvesting. And like, that's part of the value proposition. Now, to be fair, like we do occasionally do loss harvesting too. We're just very selective about when we do it. And that's kind of what we talked about last time we covered this topic. So I want to be clear that I'm not saying this is a bad strategy. I just think the way that it's promoted in many cases is a little bit misleading. And that's what we're going to talk about. So what is loss harvesting for anybody listening that maybe does not know what it is? It's the process of selling a security that it is at a loss for tax purposes. So the value is less than its adjusted cost basis, which is basically what you paid for the security. And then not buying that same security back for at least 30 days. In Canada, we have superficial loss rules where if you sold it to get the loss and then bought it back before 30 days, then, or within 30 days, then the loss is denied as a superficial loss. And in the United States, they have the wash sale rules, which are, as far as I know, the same thing, but in any case, they're similar. And it's to avoid, it's to avoid capturing the loss without capturing the loss and continuing to own the security. They don't want you to do that. So if you do this, if you trigger the loss, and you have a gain to offset in Canada, if you have a gain in that tax year or within the last 3 tax years, you can use the loss to offset that gain and get what's basically an immediate tax savings. Now you take the proceeds from the sale. So you've got the security that you've just sold at a loss. You take the proceeds from that sale, and I said you can't reinvest it in the same security, but you're going to reinvest it in something that's very similar. In Canada, it can't be identical. So that can't be the same stock. If it's an ETF, it can't be an ETF tracking the same index. But you can reinvest the proceeds in a non-identical property. But you're selling this thing at a loss, which means when you rebuy in the new asset, whatever it is, your cost basis on the new asset is going to be the same as your sale proceeds from what you just sold, which means effectively, because the thing that you sold had a higher cost base, which is why it was at a loss, when you do the reinvestment, you're reducing your adjusted cost base relative to if you had not done this procedure. A lower adjusted cost base means when you eventually sell that asset in the future, you're going to have to pay the tax on that amount. So even though you're getting an immediate tax savings by triggering this loss, you're creating a larger future tax liability that should directly offset your immediate tax savings. The difference is in the timing. So you're deferring tax and you're getting the time value of the tax savings between when you get the tax savings now and when you pay that tax bill later.
That is key. You have to understand this to get the rest of your points. This is not a way to save tax. You're simply deferring tax.
Yeah, so tax loss selling is a tax deferral strategy. And you're right, that is important to everything else that we're going to talk about here. Now, tax deferral is a good thing. Like, don't get me wrong. I'm not saying that tax loss selling is bad because it's just a deferral. Deferring taxes is good. And that's the central argument for loss selling. Like, if you can pay your taxes later as opposed to now, yes, that's that is a good thing, but it's also not that straightforward. That's not the only thing that's going on here. Now, I built a very basic model to estimate the benefit of capital gains tax deferral by comparing a hypothetical investor who uses loss selling to defer 100% of their capital gains each year for 20 years. Now, in my example, I'm assuming that this person has capital gains to offset. So that's important, because if an investor did not have capital gains in the current year or past 3 years, or maybe the following year, like if they know they're going to have a gain in the very near term, if that's not true and you're just triggering losses for the sake of triggering losses, you can carry those losses forward, but they're not going to do anything for you.
Right. So this is realized gains, though, not unrealized.
That's correct.
You need realized gains to soak up those realized losses.
That is correct. You have to have realized gains. So in my example, and the same assumption is made in the papers that I found covering this topic, there are realized gains available to offset with the losses that we're triggering through the tax loss sales. So I did in my model, I had a 20-year time horizon, and I compared the loss selling case to just a straight buy and hold case. I had a 53.53% tax rate, which is the highest personal tax rate in Ontario in 2021. And I used an expected return for my base case of 7% per year. And I split that up as 2% in income. I didn't differentiate between Canadian dividends and income, but just income. So 2% income, 2.5% in realized capital gains, and 2.5% in unrealized capital gains.
Okay.
Now, even that, as a note, is a pretty aggressive assumption. Because realistically, I don't think our clients are realizing 50% of their gains every year. I mean, I know they're not. It's a much lower proportion of gains that are being realized. So that assumption will itself make loss harvesting look more attractive. Because if you're deferring your gains anyway, you don't need to do the loss. You don't need to do the loss sale if you're not realizing any.
You're already deferring them.
Yeah, well, exactly. So you don't need to do anything fancy. And that's one of the things that comes up when you start digging into when does tax loss selling make sense. One of the criteria is if you're doing a lot of trading. So if you have an actively managed strategy and you are realizing a bunch of gains, then this whole process becomes more compelling. But if you're a buy and hold index investor and you're almost never realizing gains, that diminishes a lot of the value. And that's not even an angle that I looked at in this analysis. So that was the base case. I also made a case where returns are higher than expected. So instead of the 7% total return, I did a case where we've got still 2% dividends, but our capital gains are 8% instead of 5%. And I again split that between realized and unrealized gains. And then I did a low returns case where the total capital gains are 2% per year. Again, split between realized and unrealized. And then I compared these to the investor who didn't do any loss selling and then realized all their gains. Or in both cases, they're realizing all of their gains at the end of the period. The person doing the loss selling is going to have a bigger gain because they've been reducing their cost base throughout the period. So in the base case with the 7% return, I got 23 basis points of tax alpha. And that's, excess returns due to tax reduction.
How much loss selling goes on, and how did you choose what to take the loss on?
The way that I modeled it, because I didn't have actual securities in the model, I just had account values and adjusted cost bases and unrealized gains. So in the case where I'm doing the loss harvesting, the way that I captured that was that there were no realized gains in each time period, and all of the realized gains just accrued as unrealized gains. So in the normal buy and hold case, you're realizing half your gains. In the tax loss selling case, It's as if none of your gains were realized because you're executing perfect tax loss sales to offset all of the gains, and then they're decreasing your adjusted cost base, increasing the unrealized gain. So at the end of 20 years, the loss selling model has a much larger unrealized gain. But they haven't paid all those taxes on realized gains along the way like the buy and hold investor has.
Fascinating.
So that's kind of just a hack way to do the model. Like I didn't have actual securities. It wasn't an empirical analysis using historical data or anything like that. Although I did look at some papers that did that, but my model was very simple, but I think it does answer the question, and it actually matches up with the results of the empirical papers that we're going to talk about. So
But it makes sense going back to your initial comment, which is you would only trigger losses enough to offset realized gains. So you're assuming there's no other gains going on in the person's life, just it's portfolio centric.
Correct. And then they're able to find enough losses to perfectly offset the gains that they would have otherwise realized.
Gotcha.
So it's a very simplified model, but again, I validated the model by comparing it to the empirical papers that we're going to talk about, and it matches up. I was actually surprised after the fact when I looked at these papers in detail and found that they matched up with my model. This guy was kind of nice. Okay, so in the normal case, 23 basis points of tax alpha. In the low return case, the tax alpha was only 5 basis points annualized. These are all annualized figures. And in the higher return case, so that's where we had a 10% return, the tax alpha was 49 basis points. And this is one of the things that when you start digging into when does tax loss selling make sense, high returns, high expected returns, I guess, are a requirement, as we just saw, I guess, but they're a requirement to make this make sense. Because if you think back, what is the value of loss harvesting? It's not a tax savings, it's a tax deferral. So the more, the higher your returns are, the more valuable that deferral becomes.
Yes.
And we see that in the model that we just went through. So for my base case is an investor taxed at the highest marginal rate now and in the future. The benefits of tax loss selling were 23 basis points if returns are 7%. So that's kind of my base case, 23 basis points of tax alpha. Now, I assumed a constant tax rate for that 23 basis point number. Mm-hmm. But there are a couple details here that I think are really important. One is that some investors might expect to be in a lower tax bracket in the future. And we talk about, like with the RRSP, which is a tax deferred savings vehicle. You put money in at a higher tax rate, take it out later at a lower tax rate. You get this kind of bonus for being in a lower tax rate in the future. And it's the same kind of concept with loss harvesting. If you can defer taxes now at a higher tax rate and pay them later at a lower tax rate, that makes things look that much better. Now, on the other hand,
for tax loss harvesting.
What did I say?
No, I'm just finishing that. Tax loss harvesting. If you're in lower tax bracket later, tax loss harvesting becomes more attractive because you're harvesting at higher tax rates.
Right.
And deferring to a lower tax rate.
You got it. I completely agree. The other side of that, though, that point is that there's been all this discussion in Canada about the capital gains inclusion rate increasing. For people that don't know Canadian tax, if someone has a capital gain, you pay tax at your tax rate, at your marginal tax rate, on half of that capital gain. But there's been a lot of discussion about the capital gains inclusion rate potentially going up to 75%. So effectively, your tax rate on gains increases in that case.
Therefore, don't do tax loss harvesting.
Well, if you get that outcome, then it's no longer it's no longer a benefit. So that current and future tax rate question becomes really important. So I ran the numbers on this too, and I used the 7% expected return case to compare it across different future tax regimes. I used one with a lower future tax rate, and I just did 25% capital gains inclusion instead of 50%. And I did one higher tax rate with 75% capital gains inclusion. In terms of actual percentage tax rates, that ends up being 14% in the low future tax case, which is about what somebody in Ontario in 2021 would pay if they had $75,000 of income. That would be roughly their marginal tax rate. Yep. And in the 75% inclusion rate, that equates to about a 40% total tax rate on capital gains. And just for context, the current highest rate on capital gains in Ontario is 27%. So in my low future case, we're cutting roughly in half. And in the high future, the 75% inclusion case, we're adding about 13% to future taxes.
Exactly.
So if future taxes are low, tax loss harvesting gives me 46 basis points of annualized tax alpha.
Makes sense.
Pretty good. Double my original base case with a constant tax rate. And if they're high in the future, so if the gains rate, the gains inclusion rate increases and you stay in the highest tax bracket, because that's the other input to this, the tax alpha drops to -4
Wow.
basis points. So in that case, you're actually shooting yourself in the foot. There's a lot of ifs though, right? Like if the gains rate inclusion rate goes up, and if you're still at the highest marginal tax bracket, and that, then that's the bad outcome. But that's also one of the considerations that we'll talk about once we've covered off the rest of the topic. So obviously, as we just described, the difference in current and future tax rates are significant. I think there's an important nuance here between Canada and the U.S. Like so much of the financial research comes from the United States. So many of the products and pitches come from U.S.-centric companies. So I think in Canada, like high net worth investors probably get a lot of information from U.S.-centric sources. So you hear tax loss harvesting, and it sounds really compelling. In the States, even if your tax bracket stays the same, or your level of taxable income stays the same, there's going to be a difference in short and long-term capital gains tax rates. Short-term capital gains are taxed at a higher rate than long-term capital gains in the U.S. In Canada, it's not like that. It's you pay tax at your tax rate on half the gain, no matter how long you held the asset for. So I think that makes a big difference, because if in the States you get this automatic boost from the difference between short and long-term capital gains taxation. Okay, so now I want to jump into this paper. One of the papers that I found, this is a 2020 paper in the Financial Analyst Journal, an empirical evaluation of tax loss harvesting by Shomesh Chaudhary, Terrence Burnham, and Andrew Lowe, who's at I know Andrew Lowe is at MIT. I'm not familiar with the other authors of the paper, but it is published in Financial Analyst Journal, also on SSRN, so we can link to that version. So they find in their analysis, so I'll talk about what they did. They did an empirical analysis where they simulated a tax loss selling strategy using actual U.S. historical stock market data for the 500 largest stocks in the U.S. market from 1926 through 2018, and they found, and this is a big number, they found a 1.1% tax alpha over the full period. That's pretty meaningful. You start throwing around 1% tax alpha, like that's, okay, let's go.
But thanks to your setup, listeners are saying, like, what are all the other factors?
Yeah, so they made some assumptions that they're not bad assumptions, they're not wrong assumptions, but they're assumptions that I wanted to modify a bit, which is what we're going to talk through here. So they assume that you're doing 1% per month of new deposits into the account. Okay. For a lot of people, that's maybe a reasonable assumption. For other people, maybe it's not, but I just think it's worth pointing out. They assumed short-term capital gains are taxed at 35% and long-term capital gains are taxed at 15%. They ignore the wash sale rule. So they assume that you can realize a loss and reinvest in the same security, which, as we talked about earlier, is not a realistic assumption. Mm-hmm. I get why they did it. It would be hard to do something else because you can't really find a comparable. So I don't know how they would find a comparable security to replace it with. Anyway, so that is what it is. Now, they did look at a bunch of different scenarios, though. So they looked at a case where short and long-term capital gains are taxed at the same rate. If they tax them both at 35%, the rate for short-term gains in the U.S., the tax alpha drops to 51 basis points from 1.1%.
Wow.
So pretty significant. I found it interesting that 0.51% is almost identical to the high return sample case with constant tax rates. Now, maybe that shouldn't be surprising because, like we mentioned before, in Canada, there is one tax rate for capital gains. So the fact that holding, in their model, holding the rate constant ends up giving us a result similar to my model is perhaps not surprising. They also looked at a 20% constant tax rate on short and long-term gains, which is even closer to Canada because we're at 27% at the highest rate. And the annualized tax alpha drops to 31 basis points. So I did a little linear interpolation and found that at a 27% tax rate, you'd be looking at about 39 basis points of tax alpha. But that's before making all of the adjustments that we're about to talk about next. So they found, based on the 500 largest companies, and they did have, like you asked about turnover earlier, Cameron, they did have turnover figures because they were using historical data. It was like 30% turnover roughly, I believe, if I remember correctly. but they're in their model, they found an estimated transaction cost of about 16 basis points per year, and that's based on 0.5 basis points per 1% of annual turnover from the loss selling strategy. Again, to reiterate, they're using the 500 largest U.S. stocks for this sample. So, and the transaction cost estimates were based on that. So if we're doing like total market U.S. as opposed to the 500 largest companies, your transaction costs are going to be higher.
So do you know what rules they were following for triggering the losses?
Yeah. So it's there's another 2003 paper that did some simulations on this, and they followed the same methodology as them. They were using tax lots. And they were just selling whatever tax lots had losses in each period. Now, tax lot accounting, that's another important point that we're going to have to cover. That's an important difference between Canada and the U.S. In the U.S., you can have you can group things by tax lots, and I'm not going to pretend to fully understand all of the nuance there because this is very U.S. tax centric, which I'm nothing of an expert in. But if you have different lots of the same security, you can choose which tax lot to sell. So if you've bought a bunch of the same stock at different time intervals, you can choose the one that's at a loss, the lot that's at a loss.
Yep.
In Canada, our cost base calculation is the average cost. There's no room to choose a lot to do your sale.
But that makes sense. Then when they trigger a loss, are they using that loss to offset other gains that are realized by the portfolio, or do they assume the investor has other gains somewhere else to offset?
That one. They're assuming that they're against offsets. The same assumption that I made in my model.
Gotcha.
And that again, that becomes an important nuance that we're going to cover off as we move along here. But you're
last question, and what about diversification? They put rules in that, let's say they're all down. Would they sell?
That was not in their model, as far as I know, from reading the paper. And that's, again, you're touching on one of the other important points that we're gonna get to as we
keep jumping here.
You're asking good questions.
I try to think like the listeners. So, anyways,
okay. So where we ended off there is we had I had the 39 basis point estimate of with Canadian tax rates, and we had the 16 basis points of transaction costs. But then just to go back a little bit more, they had found in their base case in this paper 1.1% as the tax alpha. And it's worth noting too that when you look at marketing material for loss selling strategies or products, that's what you tend to see. Sort of 1 to 2% tax alpha is what you can expect from the strategy. So the paper so far, at least in that base case of theirs, lines up with kind of what you see in marketing material. So the other thing that I wanted to look at, and again, fortunately, they did these calculations. What if you're not adding 1% per month to the portfolio? And the reason that matters is that if you're adding to the portfolio each time you make an addition, you're bumping up your cost basis, or you're creating new tax lots if you're in the U.S. But either way, you're giving yourself more opportunities to do loss sales. Whereas if you're not making contributions, eventually you're not going to have any opportunities for losses if everything ends up at a gain, or most things end up in a gain position. So their base case estimate, if we take out that 1% contribution and just leave it flat, drops from 1.1% annualized to 0.73% annualized. And then what I did is I took the relative reduction in tax alpha associated with the 27% tax rate and applied that to 0.73%. So that gives us a 0.26% tax alpha. I'm kind of creating my own base case here, so no additional contributions with Canadian tax rates. So 26 basis point tax alpha before transaction costs, and we had those 16 basis points to wipe off. So that's 10 basis points that we have left over after transaction costs. So I don't think that's super attractive, especially when we talk about some of the other stuff we're about to go through here. So that's my base case. My base case is 10 basis points. If you're making contributions, then it's higher, and that's important to be mindful of. Now, the other big thing here is that we're talking about 1926, 2018. That's where you get the 1.1% starting point for tax alpha.
Yep.
They also looked at sub periods, and you start looking at the sub periods, and there's some pretty significant nuance in here too. So the tax alpha in this paper's base assumptions from 1926 to 1949, think about what happened over that time period. Lots of volatility, lots of serious losses, and lots of serious gains after those losses. Tax alpha over that period was 2.29% per year. Pretty significant. And a lot of that was driven by Great Depression related stuff with the serious losses for a period of time, tons of volatility, and an eventual bull market.
So an opportunity for more tax loss harvesting.
Tax loss harvesting and yeah, exactly. And one of the issues with this, with the fact that a time like that is, and they bring this up in the paper. This isn't my commentary; it's theirs. They're assuming that there are gains to offset, but if you think about practically, if you don't have magical gains to offset, the value of a loss selling strategy empirically comes when there are massive losses, like in the Great Depression. But if you think through that scenario, you probably don't have any gains or much gains to be offsetting. So in the model, that's when this strategy is the most attractive, but it's also when you're least likely to have gains available to offset to make the strategy work. So in that most extreme period, tax alpha 2.29%, with the caveat that I just mentioned. And then other time periods, the tax alphas were lower. 0.57% was the lowest from 1949 to 1972. And then I think one period was around 0.8 and one was around 1%. But you take out that Great Depression madness, which can sometimes make sense to do when you're doing this type of analysis, and the average value in their base case drops pretty significantly. And that's still based on the differential between long and short-term gains rates, tax rates in the States, and the 1% monthly contributions. So I think if you make the adjustments for Canada, strip out the Great Depression, or even if you don't, I mean, without doing that, I was still at 10 basis points of estimated tax alpha. Now, the other thing, I mentioned the importance of average returns over the time period in question in determining the ex post value of loss harvesting. The period we're talking about in this empirical analysis, the annualized return in the U.S. stock market was 9.75%, which is close to my high 10% return scenario in my simple model, but obviously a lot higher than the expected return for, I mean, especially for the U.S. market, considering how high prices are there. Now, the other thing to remember is fees. So if you're doing loss selling with ETFs in your own account, you're paying transaction costs. You're dealing with tracking errors still, but you're not really paying fees. And these products are more common in the States than they are in Canada. But when you see a separately managed account being advertised with loss selling being one of the features of it, you're going to pay more than the cost of owning a total market ETF.
Yes.
Like an ETF's 5 basis points for market, maybe it's 25 for something with a value tilt or a small value tilt. I didn't price out separately managed account options in the US, but you're going to pay more than that to have this loss selling service applied. So I think that's a big issue too. And then tracking error. So you mentioned tracking error. We've finally gotten there now. There's a paper by Birkin and Yee, and this is they did a simulation, but the other paper that we just mentioned by Andrew Lowe and company, they followed the same methodology, just with empirical data. But the tracking error issue was described in Birkin and Yee, is a 2003 paper, as portfolio lockup, which I think is kind of a cool way to think about it. But this happens when gains are deferred and then the increase in the market value of the portfolio becomes larger than its cost basis. So you end up getting stuck with the security that you were using as a placeholder when you made your loss sale.
There you go.
Right. So over time, this accumulates and you can end up with a portfolio that is very different from the portfolio you would have had if taxes had not been driving your investment decisions. And I think that's really important because it's like we assume, okay, here's the optimal portfolio. by doing tax loss selling and due to this portfolio lockup issue, you are going to have a portfolio that is different, ignoring taxes for a second, that is different and has, well, probably if your optimal portfolio is designed to have the exact risk and expected return characteristics that you want, the loss sale portfolio is going to be different, which is, I think, by definition of the way that I just explained that, suboptimal. And it's because taxes were driving the investment decisions. If the tax savings are sufficient to offset the tracking error, then that's great. But I think as we've talked through this, it should be somewhat obvious that it should be obvious that it's not obvious that the tax alpha is going to offset stuff like tracking error and all the other issues that we talked about. Now, I do want to point out, like I mentioned earlier, we do loss selling in some cases. Like last March and April, we were combing through all of our clients to see where loss sales could make sense. Now we're doing it at the fund level, not at the individual underlying security level, but similar thinking, I think, applies. So what I did want to talk through was the cases where loss selling can be a compelling strategy. Because I'm not saying that it's total garbage. I'm just saying it's maybe not as attractive as it can be pitched as being. So you have to expect high average returns from the asset. You have to expect high volatility and high cross-sectional dispersion of the individual security returns in the market that you're applying the strategy to. If you don't have that, then there aren't going to be loss selling opportunities. I think volatility and cross-sectional dispersion are kind of a given in most stock markets. Average returns are obviously very uncertain. There's another interesting one in here, which is you're losing positions. So when you're doing the tax loss sales, you want your losers to have low trading costs. But I don't think that's that obvious. If you're selling your losers, I don't think it's obvious that they're going to have low trading costs. So another way of saying that is that the 16 basis point estimate for trading costs may be unrealistically attractive. And if you're really selling your losers, especially if it's not the 500 largest stocks like the paper that we were talking about, my estimate is you'd have higher than a 16 basis point transaction cost drag, which of course the buy and hold investor would not have, because they don't have the high turnover that the loss selling strategy does. And then at the level of the individual, so I just talked about what the market has to look like. At the level of the individual, you should be expecting a lower future tax rate relative to your current tax rate for this to make sense. You have to have capital gains to offset. Like that's a huge assumption that's made in these models. You've got to have, and that's got to be gains within the current year, past 3 years in Canada. Or if you're really sure you're going to have realized gains in the next year or two, maybe, then maybe this becomes interesting again. You should be making contributions to the account. There's a big drop off in the efficacy of this strategy if you're not making contributions. If you're making withdrawals, it gets even uglier. So, this is for someone in the accumulation phase of their, which matches up with the tax rate differential. Yeah. Like if you're accumulating, there's a good chance, unless someone has significant wealth, there's a good chance they're going to be at a higher tax rate now than in the future. And you've got to be comfortable eating tracking error, and that's an unpriced risk. You're taking some random risk with the loss sale portfolio relative to the otherwise optimal buy and hold portfolio. I did want to mention a couple things on funds as a structure. So I mentioned separately managed accounts, and those do exist in Canada. I don't hear about them nearly as much as you hear about them in the U.S., but they are still in Canada pitched to high net worth investors as a way to improve over the fund structure, because you get to do tax loss selling, you get to control your overall portfolio. You're not beholden to what other investors are doing inside of a fund. All that kind of good stuff, I think, tends to get included in that pitch. But pooling funds with other investors has some interesting tax attributes. A fund can use its cash flows to the advantage of all fund holders. If a fund has positive cash inflows, the inflows dilute any unrealized gains inside the fund by increasing the average cost basis of the securities in the portfolio in Canada, or creating new tax lots if you're in the US with their tax lot accounting. And then the inflows also can facilitate portfolio transactions like rebalancing, using new cash as opposed to having to sell securities. I think that's an advantage. If a fund has positive inflows, that's an advantage over doing individual securities or even individual ETFs in an account. Now, those are referred to as a paper that I found by Dixon, 2000 paper, and he refers to this as positive tax externalities for equity funds. Now, negative flows. So I just talked about why positive flows into a fund can be a good thing for all unit holders of the fund. Negative flows would then seem like they're probably a bad thing. But in Canada, we have these two mechanisms, the capital gains refund mechanism and the allocation to redeemers methodology. And they're designed to avoid double taxation on fund redemptions. So I'll talk about allocation to redeemers. When an investor leaves a fund, the fund can allocate capital gains to the redeeming unit holder and claim a corresponding deduction that reduces the gains for the rest of the unit holders in the fund. The allocated capital gains are included in computing the redeeming unit holder's income, and the unit holder's redemption proceeds are reduced by a corresponding amount. So it can, the negative flows, people taking money out of a fund, can attenuate the negative externality of negative flows, because you can end up in a situation where a fund has realized gains that get pushed out to unit holders that sold the fund instead of being distributed to existing holders of the fund. So I don't think it's true in Canada that people leaving a fund or even net negative flows are guaranteed to be a bad outcome for the remaining unit holders in the fund. So I think that's an important piece where there can be a perception where holding individual securities or having a separately managed account, because they're more flexible, I guess, or you have more control, they can seem like better options than owning through a fund if you have the scale and the opportunity to own them directly. But I think there's a pretty good argument that funds can actually be more tax efficient than holding stuff directly. And then just to finish this topic off, I wanted to talk about a couple, and we've mentioned them throughout the discussion, but there are a couple of points specific to Canada, and I just want to reiterate those. Because again, we often hear about loss selling from the perspective of U.S. investors and U.S. research. Even the papers that I looked at, they're all based on U.S. tax code. So, and this is one I actually haven't mentioned yet. In Canada, we don't have a step up in cost basis on death, which is something that, as far as I know, the U.S. has. I think Biden was looking at getting rid of it, but I don't know if they did, or maybe putting a cap on it. Anyway, in the U.S., if you die with a taxable account, you get a step up in cost basis on death, which means you don't pay gains tax on all of your appreciated securities. Your heirs or your estate gets the assets at their market value. So the cost base is reset to market value on death. In Canada, we absolutely do not have that. If the second spouse dies, the full gain is taxable on the terminal tax return. Now, in Canada, you can donate those appreciated securities, and that makes the gain go away. But ignoring that, or assuming that that's not what somebody wants to do, in the loss selling case, you end up with this massive unrealized gain, which could push you into a higher tax bracket if you're not already in the highest tax bracket. And the other big one is Canada uses average cost for the basis of securities, where the U.S. uses tax lots. They didn't separate out how much tax lot accounting contributed to their calculated tax alphas. So I can't make a statement on, it was 1.1% with tax lot accounting and X amount with average cost, but it would have been lower using average cost accounting, and there'd be fewer opportunities to do loss sales. So I think that's an important piece for a Canadian thinking about, should I do this? The fact that we do average cost is important. And then the last big one that I think I've already hammered home, but I'll mention it anyway, is that we do not differentiate between short and long-term capital gains in terms of the rate that you pay. So I would summarize all that as tax loss selling can be useful. I definitely wouldn't pay higher fees than owning a total market index fund in order to access tax loss selling. I think if you hear, you get a 1% tax alpha, that should raise some red flags, or at least result in some deeper due diligence in terms of how that is being estimated. I think based on the numbers we just walked through, it's highly sensitive to the inputs, but I think with reasonable inputs, I would say a 1% estimated tax alpha from loss selling is a little bit too aggressive. And then the last piece for our Canadian listeners is that, a lot of this stuff is way different in Canada than it is in the US. And I was, to be honest, surprised at how different the numbers start to look when you make it applied directly to Canada as opposed to a US investor.
So to me, the takeaway, and perhaps we have to make a t-shirt with this, it should be obvious. It is not obvious. Another Benism.
It should be obvious that it's not obvious.
Another great Benism. Okay, on to the Talking Sense cards.
Yep.
Again, this is the initiative from the University of Chicago Financial Education Initiative. Number 1 card. Ooh, interesting. Would you rather follow a path laid out for you or set a path for other people to follow? For me, for sure, it's a rather interesting question, actually. I like to set my own path. But that's not the question. The question is, do you want to follow a path laid out for you or set a path for other people? I guess effectively we're living by setting a path for other people, kind of in what we do for people, but also in building the team and building our service. So I'm in the set a path for other people to follow.
If I feel like I'm following a path that somebody else has set, I get very uncomfortable very quickly.
That's also an interesting point, because the path we're following is a path that we are all creating as a team, each in our own roles, but together we're kind of going in this direction, right? Kind of gets back to the strategy question, which is interesting.
I think that's all I got. Not a fan of doing the whatever seems easiest or following a predetermined path.
Question number 2. This one is very interesting, and we've not seen these. So, what could you do to protect yourself from something you worry about?
Buy insurance.
I guess it depends on what you worry about, right? You can't buy insurance on your kids turning out to be great citizens. Can't buy insurance for lots of different things.
Say the question again.
What could you do to protect yourself from something you worry about?
You can be stoic about it. Separate yourself from it.
Yeah, people often laugh at me. I seem to have some ability to completely be able to sit and not think about anything, which I know Lisa always says, doesn't get how I do that, but I'm able to just be, not even worry about, if I wake up in the middle of the night, it's often I swear to you, there is nothing on my mind. It's not like I'm worrying about work or other things in my life. I don't worry about a ton, but to protect yourself.
I can't relate to that.
Well, you worry about stuff when you wake up in the middle of the night?
Well, I don't think about nothing. I don't know if I worry about stuff, but my mind does start racing. I find to not think about anything, to not think about anything other than the task at hand. My favorite activity is challenging walks in the forest, where you literally can't think about anything else because you'll fall on your face by tripping over a rock. That's the best to me. Interesting.
I think that's true for any extreme sport or activity. It just forces everything out of your head for that period of time.
Yeah, that's probably true.
On to bad advice of the week, quickly. We've talked a lot lately about how the fees of the Canada Pension Plan have risen over the past 20 years, and this prompted a bad advice of the week submission from listener Stuart in the UK. So as always, if you contribute something we use in this segment, we'll send you off one of our hoodies. Anyways, he opened it by saying this may not be bad advice, but it could lead to bad advice in the pension world in the UK. So the UK's Department for Work and Pensions, the DWP, and this is from what I understand in reading a number of articles, has long had a cap on how much the fees can be inside their plans. These are for DC, defined contribution plans. The fees had been capped or are capped at 75 basis points. The average charge rate now is 48 basis points, which is well below the cap, and I would say is certainly in the reasonable range. But you can probably guess where this is going. So I read another article that suggested that the DWP confirmed there will be no change to the 75 basis point charge cap for DC pension schemes. However, this cap is proposed to be loosened in October this year to allow schemes, that's their word, schemes to pay performance fees. So the objective is to remove the barrier to investing in illiquid asset classes, much like what you and I talked about in the Canada Pension Plan, that generate performance fees, allowing schemes to accommodate the ebb and flow that sometimes is associated with the performance fees of these assets, yet still remain within the cap. So there are new rules apparently coming out this October in the UK to somehow allow those ebb and flows to fit into the pension cap, the fee cap of 75 basis points. And apparently the overwhelming majority of respondents to a survey they did supported the proposals to allow DC schemes to smooth these performance fees over a 5-year period, with the goal of enabling greater investment in illiquid assets.
It's crazy to me. You end up paying for the illiquidity premium. Remember that one we talked about a while ago?
Mm-hmm.
The valuation of illiquid assets increase because people like the smoothing effect that they have in portfolios. So you end up with lower expected returns. Instead of a premium for illiquid assets, you end up with a negative premium.
So maybe you better get the DWP on the blower and bring them up to speed.
Stuff like this shouldn't be a surprise because, you know, as the growth of super low cost index funds, like there has to be some other frontier for financial businesses to try and find margin, right?
Maybe that's
they're not just going to roll over and die and you know, okay, well we're out. We're going to stop making products now. There's got to be, and there's lots of smart, talented people out there too that probably think they can find alpha. I'm not saying that it's malicious or anything like that.
But it's kind of ironic that we talked about a book on business strategy earlier. It's exactly, and we talked about the U.S. asset managers. So look at that, all ties together. Anything else?
Nope. We got a bunch of new reviews recently. We're at almost between all of the different Apple podcast platforms, like the different country platforms. We're at over 600 ratings now, and not all of those are reviews, but we do always appreciate when people leave us reviews. We read all of them. We read many of them out on the podcast. So if you're listening and getting value out of the podcast, we do appreciate a good rating, and a nice review is also appreciated.
And remember, for the dog days of summer in our store, for 20% off at checkout, put in the code RATIONALSUMMER, all lowercase. We'll get to see how many people interact with that based on this podcast. We're only mentioning on this episode. So we'll see. Go and get a bargain for your dog days of summer Rational Reminder Ensemble. The hoodies are comfortable, let's face it. All right. That's it.
That is it.
Thanks for listening.